Hey everyone, welcome back. Thought I would go over last week's price action, the emotional response to that, today's price action, as well as some of the absurd news of the week, and also go over how I would re-enter the market if I dumped in fear last week. So if you were looking over social media, you would expect the chart to look something like this. First, we were falling out of the sky, going to zero, and then we were going to the moon this week. So the reality is this is what the actual price action looks like. We had a retracement of about 11.5%, and 6 days later, we are back at the same price we were at 6 days ago. So it's important to keep things in perspective and not, you know, make your trades in a state of fear. And looking at the fear and greed index, you can see that it correlates with the price action. And the biggest thing that you need to understand is that the market is designed to elicit a response based off of your emotions, and they will extract all of your wealth if you let them do that. So you need to be disciplined. The saying is that you buy into fear, sell into greed, and that doesn't mean that you buy into falling knives or sell into rising price action. There's other things that you need to look at, and that's what we're going to do today. But first, we're going to go over some of the absurd news. And here we have Senator Elizabeth Warren of Massachusetts and Angus King of Maine pressing the Biden administration for information on how it is addressing Iran's use of cryptocurrency mining to evade sanctions. In her statement, she said Iran has raised millions of dollars through mining crypto, a steady revenue source that allows it to purchase imports, move funds domestically and internationally, and fund Hamas and other terrorist organizations. Now, the big thing here is that the United States is most likely not going to be able to do anything when it comes to foreign nations utilizing Bitcoin, and that's really part of the beauty of Bitcoin. It is neither good nor bad, and I'm certainly not backing Iran's actions here, but using your money your domestic money as a weapon is the result of nations finding a way. Bitcoin is, for lack of a better term, like the saying in Jurassic Park, nature finds a way. Money is an emergent property of human nature, and humans will find a way to transact. And Bitcoin is the best emergent money for that kind of operation. But there's nothing that the United States is going to be able to do about this. In other news, Freddie Mac wants to re-enter the secondary home loan market in a win-win for the government, Wall Street, and consumers. In 2007, just before the financial crisis, there was more than $700 billion in home equity loans outstanding. Today, there is roughly $350 billion and home prices have risen more than 70% since then. So this is what Freddie Mac wants to do, and I'm going to tell you that this is a terrible idea. Anytime there's any type of win-win between the government and the private sector or the public sector, it ends in catastrophe because you are doing financial engineering, and there's always going to be a consequence to that. And here's why this was a bad idea. And that's because we had the great financial crisis, which was created through financial engineering that the government uh, elicited. So this is a terrible idea. I hope it doesn't get passed through. If it does, well, then I'm going to trade accordingly, and I'm probably going to buy more Bitcoin once we have a dump. So this is the directional movement indicator that I discovered, and this is something that I like to look at as far as trend analysis and where I am in the Bitcoin cycle. So I got this from Crypticon on Twitter, and I think it's another tool that you can use in your tool belt to include things like the Pi cycle indicator, the stochastic RSI, and MACD on the monthly and 2 monthly time intervals. And when you look at this, you're going to discover that there is a lot of information as far as the larger cycle is concerned and whether we're in a uptrend, despite a lot of the noise when it comes to 11% corrections like we saw last week. So this is something you could find on TradingView, and you can do your own analysis, but Crypticon shows that we are still in the inside support zone as elicited by the previous 3 cycles. So we are still in an uptrend. And we retested that line as well on the chart at $56,700. That is a check in the box as far as we are still in the bull run. Now, the other thing I like to do is I like to do trend line analysis on the daily chart and look at the larger time frame for that interval. So we are currently in a parallel ascending channel, which has been respected 1, 2, 3, 4, 5, 6 times. And the last time was that dip. So we tested the upper portion of this parallel ascending channel, and it should have been expected that we were probably going to retest the lower side of this channel as the sinusoidal price action continued to the upside. So this shouldn't have been a surprise. It might have been a surprise that we actually started to go parabolic. We had some irrational exuberance. But that's generally how price action works. We never go up in a straight line. Now, there was also confluence here. As you can see, there was a demand zone, and there are indicators that you can use on TradingView to place these areas of supply and demand. I use the SD boring indicator. There's others that you can use, and use the one that you feel comfortable with. Now, the other thing that occurred is that we basically had an area of consolidation here, and that is in confluence with this other trend line. So you have various trend lines that you can create using the price action, and there's various ways that you can do that. But this one has a point that was created here. We had another rejection over here. We rejected, consolidated in the area of demand, punched through, and then we continued up with the price action. And as you can see, this area was respected back over here. We punched through it due to bad GDP numbers, bad CPI numbers, as well as what really sparked it was the international conflict in the Middle East. But we hit that area of demand, recovered, punched through that short-term trend line, and now we are using it or we're testing it as support. Now, during that consolidation, we also created a descending parallel channel, and I like parallel channels a lot. I think they give a lot of good information that you can use in confluence with other indicators. But we have been respecting this area or this descending parallel channel, and we retested, or rather we punched through, and this is where I would begin to become concerned because now we're changing trend. And so there was reason for current concern last week. I'll grant that. But we did have two other areas of confluence. We had this area of demand, as well as the ascending parallel channel support line. So these are all things that you can use to alleviate your emotional response when we're having a dump like this. Now, the other thing that I like to use, and a lot of traders use actually, and that we use in our group, is the Fibonacci chart. So the other things you can use different indicators if you're having trouble to find out where to place the Fibonacci chart lines. I like to use Williams fractals, but in general, you can almost see this with your naked eye as well. You can see that we've had this uptrend on the daily. And so I place my starting point for my Fibonacci chart here, bring it to the top. And generally, when we have a trend like this, and we have identified what could be the top, which we ended up doing because we had a double top right here, is that we generally have a retracement to the 0.382 to 0.618 Fibonacci levels. We kind of did that here, but we never made it to the 0.382. We came back up, had identified this as the top, given the double top formation, retested, and without an external economic issue such as a international conflict or bad economic numbers, we probably would have continued up and retested at a triple top this parallel channel and maybe even punched through it. Uh, However, again, we had some serious economic numbers that were not going to allow us to do that. So we came back down and we had another, again, a third area of confluence. We had the 0.5 Fibonacci line. We had the lower support of the parallel channel and an area of demand. And we jumped back from here. So if you were going to make a trade that was in your favor, that was higher than 55% chance of winning, you'd want all this area of confluence. Now here is the double top that was defined. Either you get it done visually, or you can also back yourself up with auto charts if you have a membership with TradingView. And I would say that this basically has, now that we hit this area of confluence, this has basically played out and is no longer relevant. Now within that, we also have a descending wedge, and we could possibly come back down, but we did punch through it, and we could use that as support, the top part of that ascending wedge, or come back down and continue to form that wedge. And it has a corresponding price target to the 73K region, which would be an area of respecting that descending parallel channel. So that's something you can use in your decision-making process. And we also have, or we still have, that bullish flag with a corresponding price target up at the $106,000 level. Now, I'm also going to place the auto Elliott chart here, and I know for people who are very into Elliott wave, this is probably not in correspondence with how the Elliott wave should be placed as far as their lines, but this does have confluence with the bull flag target and basic bullish momentum in the chart. And now as far as the lines are concerned, I mean, I would take this Elliott wave chart with a grain of salt, and if you're really into it, learn how to actually place your Elliott waves, but I think this is okay for now. The other thing you want to look at is your simple moving averages on the higher time frame charts. I personally like to use the exponential moving averages on the lower time frames, but it's basically your choice. It's kind of subjective. But as far as the simple moving averages, this is the most popular. And right now we came down. We basically had our bull market back from October. Here it just shows February, but you can see that we were above the 20-day simple moving average, and then we began to consolidate up and down around that 20-day simple moving average, and then we dump below it, and the 50-day, which again, that's showing there's a trend, and that includes a cross, which is generally bearish, and we have been descending ever since. Now we have been basically following the 20-day simple moving average, and then testing the 100-day simple moving average as support, and we're trying to pop up above the 20 simple moving average and getting rejected by the 50-day. So those are other areas of confluence that you can use with your charts. And here they're all placed together. And I've shown what I think price action could possibly project out to be, given all of the indicators that I have on my chart currently. Now the other thing is that again, if you're an Elliott wave aficionado, a lot of traders have identified this as an ABC correction wave that is basically played out. And so we should be going up from here. You'll also notice that we do have descending trend lines that we finally broke above. And then we have this other one that we broke above as well and are testing it as support and confluence with that short-term trend line that I had mentioned before that is in purple right here. So we're testing that as support, which is a good sign. And looking at that closer, you can see with detail exactly what the price action is doing. So we're hanging around the 63K area up to the 65,500. And we actually hit the 65,500 level exactly. Now you can also, the great thing about a lot of these indicators is that they can be used on all different time frames. And given that we basically potentially bottomed out here temporarily at the 57 to $56,000 level is I can place that as the bottom of my fib chart and bring it to the top to 65.5. And I can see that we probably, or we potentially could have a retracement back to our areas that are normally associated with retracement, the 0.382 to 0.5. And ideally, if you're an uptrend and you want to get the best price available, you want to get hit into the golden pocket. And this would be in confluence with retesting the ascending parallel channel on the larger time frame, and as well as the descending parallel channel, which is which makes up our bull flag. So this is an area that you could probably place as a limit order if you want to get back into the price action or get back into Bitcoin. If you had sold everything last week, or to DCA into your spot bag. Now, again, I got the descending line right here in confluence with or matched up with the Fibonacci chart, and it could just follow along here and hit the 0.382 and then continue up. And here I have what I think the projected price action potentially could be. So now I've highlighted all of my lines, and this doesn't mean this is what the price action is going to do, but based off of all of my support and resistance lines, we could have a double top here, come back down in confluence with our descending parallel channel bull flag, our ascending long-term parallel channel support, and then continue up past this area of supply, use it as demand, and continue up and hit our more bullish targets. Now, this is the optimum scenario. That doesn't mean that we can't break through all these levels and then continue down to the 52K mark. But based on all of this resistance, you would need a lot of selling action for that to occur. So I think the favor right now is for bulls. However, that does not mean that we could have another event in the market or have worse numbers. We're going to have numbers next week, which are going to be the initial unemployment claims for this month. And that could be concerning. That could show either hiring is still high in demand and the market is running hot, which means higher inflation, which means the Fed is going to have to reduce rates, increase rates. Or we're going to show that there's less demand and we may need to stop our rate cuts, maybe even or cut our rates rather, which would potentially allow for more liquidity. And more liquidity means assets go up. So that was basically what I would do if I had sold at the bottom last week and I wanted to get back in. I would probably dollar cost average and I wouldn't go all in with my money. And that's just the unfortunate issue when you sell like that, because the market is trying to extract wealth from you, is that you really just can't just throw all your money back in and not expect it to go back in the red as we oscillate back up through our uptrend. So if you have any questions or you want me to look at any of the charts, please let me know. And I'll try and get another video out as soon as I can. All right, thanks. Bye.